Welcome to this deep dive on achieving financial security on a $45,000 income. First, we will show that financial stability depends more on savings rate and allocation strategy than on the size of your paycheck. Next, we will outline a practical budget framework that keeps core needs manageable, eliminates consumer debt early, and channels money into tax-advantaged accounts. Then, we will explore the optimal savings order, the role of employer benefits like FSAs, and strategies to accelerate wealth with bonuses and audits of recurring expenses. Finally, we will wrap with key takeaways and action steps so you leave with a clear plan. Here is our roadmap. First, we explain why your savings rate matters more than income level. Next, we set foundational targets. Approximately 60% of net income to needs and 20% or more of gross income to savings. Then, we emphasize why eliminating consumer debt is non-negotiable. After that, we cover the optimal savings order. Secure the full employer match, then prioritize a Roth IRA, and only then use taxable brokerage or high-yield savings for short-term goals. We will also discuss leveraging benefits such as FSAs or HSAs when eligible, and splitting large bills to keep overhead low. Finally, we will walk through a sample budget and the tactics to accelerate progress using bonus income. To build a secure budget on $45,000, start by compressing core living expenses. Aim to keep needs around 60% of your net income, which means rent, utilities, groceries, transportation, and insurance should fit comfortably into that envelope. Simultaneously, target a savings rate of 20% or more of gross income. Although the pie chart shows a conceptual split, remember that savings here is based on gross income and needs and wants are based on net income, so the visual is a simplified guide rather than a strict mathematical identity. The key is to build a financial defense. Low overhead, paired with consistent, high savings. This combination protects you against uncertainty and allows your investments to compound. First, a high savings rate compounds consistency into long-term results. Regular contributions matter more than chasing high returns. Next, even with a modest income, disciplined spending and a strong savings habit can outperform higher earners who overspend. Additionally, lower fixed expenses act like shock absorbers during layoffs or emergencies. Finally, eliminating consumer debt increases available cash flow, letting you contribute more to savings and investments sooner. Begin by calculating your take-home pay after taxes and any pre-tax contributions. Next, allocate approximately 60% of net income to core needs. Then, set a savings target of at least 20% of gross income, using tax-advantaged accounts where possible. After that, automate transfers so the plan runs without effort. In parallel, aggressively tackle consumer debt with either the snowball or the avalanche method to accelerate free cash flow. As you implement, prioritize the employer match first, then contribute to a Roth IRA, and use taxable brokerage or high-yield savings for the remainder and for shorter-term goals. Finally, take advantage of FSAs or HSAs if eligible, and audit recurring expenses quarterly to free up additional savings capacity. Here is a simple illustrative breakdown using approximate numbers. Monthly gross income is $3,750. A 10% pre-tax 401k contribution is $375. After estimated taxes and payroll deductions, which we approximate at around 24% for illustration purposes, the take-home after the 401k is approximately $2,475. From take-home, aim for needs at roughly 60% or about $1,485. Discretionary spending at around 20% or about $495. And a Roth IRA contribution targeting roughly another 10% of gross, about $375, funded from take-home. The remaining amount can go to an emergency fund or extra investing with a small buffer. These figures are illustrative and will vary by tax situation, benefits, and location. Adjust the percentages to fit your reality while maintaining the principle. Compress needs, protect savings, and keep a small buffer. This flowchart begins at payday and first routes contributions to secure the full employer match, because matched dollars are an immediate, risk-free return. After the match is satisfied, the next destination is the Roth IRA, up to the annual limit, since its tax-free growth and the ability to withdraw contributions without penalty provide flexibility and strong, long-term benefits. Once the Roth IRA is maxed, the remaining funds flow either to a taxable brokerage account, ideally into broad, low-cost index funds, or to a high-yield savings account when the goal is short-term. A sidetrack emphasizes building a 3 to 6 month emergency fund for stability. There is also a prerequisite note highlighting that high-interest consumer debt should be eliminated aggressively before ramping investments beyond the employer match. This sequence minimizes lifetime taxes while maximizing long-term compounding. On the left, the Roth IRA offers tax-free growth and tax-free qualified withdrawals, and contributions can be withdrawn at any time without tax or penalty. This makes it powerful for long-term growth, especially for retirement. However, it has annual contribution limits and possible income phase-outs. On the right, the taxable brokerage account provides flexibility, without contribution limits and immediate liquidity. But dividends and realized capital gains are taxable in the year they occur. It is useful once tax-advantaged accounts are maxed, or when saving for medium to long-term goals like a home purchase. Low-cost, diversified index funds are recommended in both cases. First, consider a flexible spending account to pay eligible healthcare expenses with pre-tax dollars, reducing taxable income. However, plan carefully because FSAs often have a use-it-or-lose-it feature with limited carryover. Next, if you are eligible for a health savings account with a high-deductible health plan, take advantage of its triple tax benefits. Contributions are pre-tax or tax-deductible, growth is tax-free, and qualified medical withdrawals are tax-free. Funds roll over year to year, and you can keep receipts to reimburse yourself later. Finally, lower overhead by splitting major recurring bills with roommates or partners, negotiating better rates, switching providers if needed, and automating payments to avoid late fees. First, gather all debts with balances, interest rates, and minimum payments. Next, decide on a payoff strategy. The avalanche method tackles the highest interest rate first for faster interest savings, while the snowball method targets the smallest balances first for early wins and motivation. Then, automate payments above the minimum to the target account each month and roll freed-up payments into the next debt. Meanwhile, avoid taking on new consumer debt and simultaneously build a modest emergency fund so an unexpected expense does not derail your plan. Question: what is the recommended savings order to maximize long-term growth and minimize lifetime taxes? Option A, max taxable brokerage, then Roth IRA, then get employer match. Option B, get full employer match, then max Roth IRA, then taxable brokerage or high-yield savings. Option C, skip the Roth IRA and contribute only to taxable funds for flexibility. Option D, pay off all debt before contributing to any account, including the employer match. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to get the full employer match, then max the Roth IRA, and then use taxable brokerage or a high-yield savings account. This sequence captures risk-free matched dollars, prioritizes tax-free growth, and retains flexibility for remaining funds and near-term objectives. First, direct any windfalls, such as a third paycheck in a 3-paycheck month, or annual bonuses directly into the emergency fund or investment accounts. This prevents lifestyle creep and compounds progress. Next, conduct quarterly audits of large recurring expenses like insurance, phone, internet, subscriptions, and pet or grocery budgets. Renegotiate, switch, or cancel to free up cash flow. Then, build an emergency fund of 3 to 6 months of essential expenses to create stability. Finally, once your cushion is in place, continue investing systematically in low-cost index funds and resist lifestyle creep so your savings rate remains high. Question: you receive a year-end bonus. What is the most effective move to accelerate your plan? Option A, treat yourself first because you earned it. Option B, split it by funding the emergency fund toward 3 to 6 months of expenses, then invest the rest. Option C, spend half and save half in a checking account. Option D, put it all into a random hot stock tip. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to split the bonus by funding your emergency fund toward a 3 to 6 month goal and investing the remainder. This approach strengthens your financial defense first and then accelerates long-term growth without encouraging lifestyle creep. The key wins are as follows. Your savings rate matters more than the size of your paycheck. Keep needs contained at around 60% of net income and save 20% or more of gross income. Eliminate consumer debt early to free cash flow. Follow the optimal savings order by securing the employer match, then maxing a Roth IRA, and using taxable brokerage or high-yield savings for the remainder. Use benefits and split bills to reduce costs, and send windfalls to your emergency fund and investments to prevent lifestyle creep. Before proceeding, please note this is educational content only, and not financial, tax, or legal advice. Consult a licensed professional for guidance tailored to your situation. Rules, contribution limits, and eligibility for accounts like Roth IRAs, FSAs, and HSAs change over time. Always verify current details with authoritative sources. In summary, compress needs to around 60% of net income so you can expand savings beyond 20% of gross. Secure the employer match, then prioritize the Roth IRA, and use taxable brokerage or high-yield savings for additional funds. Use benefits, split bills, and quarterly audits to keep overhead low. Build an emergency fund of 3 to 6 months of expenses and direct windfalls there first, then to investments. Finally, automate and remain consistent so compounding can do the heavy lifting toward your long-term goals. Thanks for watching. If you found this valuable, please like the video, share it with someone who could benefit, and subscribe for more deep dives on building financial stability. Tell us in the comments how you allocate your budget and which strategy you are trying next.